All Century 21 real estate offices are independently owned and operated.
This is the Real Estate Roundtable with Century 21 Jack Ruddy Real Estate. Good morning. I'm Jackie Ruddy, broker, and with my husband, fellow realtor, Pat Devaney.
Good morning, Jackie. How are you today?
How are you today?
I'm great.
I'm very good, thank you. We have, for the second week in a row, Tom Cawley, CPA and partner of Cawley, Johnson & Sanders. Good morning.
Good morning. I guess I should try to say good morning as enthusiastically as Patrick did.
Yes, you should. Absolutely.
You
Thanks.
have me back a little more often, I'll get better at it.
Oh, well, thank you for joining us. You've been here before, but it's been several years, I have to say. But we're happy to have you back. We're here every Saturday at 11 a.m., Sunday at 11:30 a.m., where we review real estate topics. We have a full-time real estate office with many exceptional realtors. We've been guiding, assisting, and advising clients in real estate matters for 50 years.
50 years. Wow. During the week, feel free to email us with any questions you have at questions@jruddy.com. That's questions@jruddy.com. Or you can give us a call at 570-344-6724. And when you're at jruddy.com, click on the webcam tab and see what's going on at Dunwall Corners from our new roof cam.
See, that's going to give me a new activity now.
New hobby.
I used to look at the webcam at Elk Mountain to see who was skiing while I was in my office.
Well, you were working.
Yeah, now I'll be looking
Jealously.
at Dunmore Corners.
My friend from Brooklyn, Bobby and Regina, he sits there. I think he needs more to do at work. And he sees me coming back from Caramia's with a bag of sandwiches. So I get the phone call I see the Brooklyn number. He goes, "You're coming back from Caramia's?" I was like, "Yeah, how do you know?" He goes, "I'm watching you on the camera."
I like to turn it on from my home to look at the weather, especially when we're getting snowstorms. And I think this winter especially is supposed to be wicked. At least that's what I'm hearing. So I'm going to be...
We need lots of snow.
No, we do not. You're a skier. I do
Yes.
not like the snow. Check us out on social media. We're pretty much everywhere. View our listings, search the MLS listings, and listen to archive radio shows by going to mobile-friendly jruddy.com, jruddy.com. Our radio shows are also offered as a podcast on many popular podcast apps. If you're looking for a podcast app to listen to our shows, go to jruddy.com, radio tab, and they're all listed there. Okay, Tom Cawley, CPA and partner of Cawley, Johnson & Sanders. If you can just tell me a little bit about you, how long you've been doing what you do, and how long you've been with Cawley, Johnson & Sanders, please, where
Sure.
you're located.
We are located on Route 6 and 11 in Glenburn. The actual address is 1310 Lackawanna Trail. I am one of the founders of Cawley, Johnson & Sanders, I guess you would say. And we started our practice in 1999. We set up our company. My partners and I were the successors of another firm. We left a place where we all worked together, and we started our company. Today we have a staff of 9. We have 5 CPAs on the staff, primarily a tax and accounting practice, and things have been going pretty well. Patrick just knocked something off the desk here. Last time he was at my office, he broke the bathroom door. So
Wherever he goes, he's like a bull. Yes, he's a bull in the china closet. He really is.
Thank you very much. Thank you for that visual.
But he carries tools in his truck because when he does that, he does fix it. I do have to say he broke the door in our bathroom, but he did fix it.
We're lucky that he's very, very handy. Thank God he's so handy.
So, yes, I can be reached at 570-563-1140, and my email address is tomc@cjspc.com. And we are always accepting new clients.
Excellent. Love to hear that. So, and you've been doing our personal taxes as well as the company's taxes for a very long time, so I can attest to your wonderful work, and you get it done. And so, we love you. I know taxmen and the taxman gets a bad rap, just like realtors do, but you know your stuff, so we appreciate that. Last week we talked about mostly primary residences and home buying and home selling, tax deductions, tax credits, etc. This week I'd like to talk about income properties, investment properties, rentals that people own, and so all the tax items that we need to know about regarding those types of properties, please.
Sure. That is always a question asked by clients. What is the tax break, or will I get a big tax deduction if I buy a rental property? So things have evolved over the years in that whole industry. That back when I started doing tax work was about the time that the changes were coming. And one of the big changes was the length of time that these properties are written off. So the depreciation numbers aren't as big today as they were back in the 80s, let's say, when residential real estate and commercial real estate or investment real estate was being written off over a 15-year period maybe. So today it's...
Yeah, what is depreciation?
That's where you recover the cost of the property that you buy. So you buy a property for $100,000. If it's a residential property, you write it off over 27 and a half years. So you're getting about $3,000 a year in depreciation. Commercial property is written off over 39 years. So that is just the structure, though. You do not write off the land. So
when you say commercial property, what do you mean by that?
Not residential.
So any investment property would be like a 2-unit, 4-unit?
No, they're residential.
Oh, those
People are living. I'm talking about where businesses would lease.
Oh,
okay, businesses.
So commercial real estate versus residential real estate.
Okay.
There's two different
Gotcha.
periods to write
like an
that
office
off.
building,
Yes.
professional building. That's all.
And the land is not deductible. So usually we segregate that. Sometimes it's stated in a sales contract. Sometimes it's not. So we just come up with, we talk to the buyer and, what do you think it's worth? So that's an expense. Now, what people don't understand, or a lot of average people don't understand, when they buy a property and they have a mortgage on it, the payments on the mortgage are not deductible. Only the interest is. So the principal amount that you're paying on the mortgage is just repayment of the debt. The expense related to that is the depreciation. And to the extent that those numbers are different, it will create a loss or it would create income, depending. If your depreciation on a property is $10,000 for a year and you pay back $6,000 of principal on your loan, then you essentially have created a $4,000 paper loss. So you might write the building off a little faster than you pay it off at the bank, or it'll swing over time. So all of the expenses related to a rental property are deductible from the income that you receive. So the rent income is the income. You get to take interest, real estate taxes, repairs and maintenance, insurance, utilities, basically anything you pay. If you pay anything for supplies to clean it, maintenance costs, you get the lawn cut, the driveway cleared when it snows. All of that is deductible. It's essentially like a business. So everything you spend to generate the rent income is deductible from that income, as well as the depreciation.
Vacancies?
Vacancies are not. You do not get to deduct lost rent because the average taxpayer is a cash basis taxpayer. So they do not pay taxes or record their income until they receive it. So if they don't receive any rent income, then there's just no receipt of income for that month. They do get to take the expenses that they incurred in that month, but they don't get to write off $600 of lost rent because they never picked it up as income initially. So that's a common question. I didn't have a renter for 6 months. I don't get to write off the $3,600 of rent.
But you didn't collect the rent.
No, you didn't collect the rent, but you do take the expenses that you incurred. So the record keeping for that is, it's not really that cumbersome. It's just you have to keep track of it, and keep track of your income and expenses. The interest is usually reported to you at the end of the year by the bank, so you know what that is. There's a little difference in financing for investment property than there is for home purchases. We talked about last week about government programs and things of that nature. I don't think there's as much of that out there, but there could be some. It's like anything else. An aggressive buyer will research that stuff and see if there's any programs out there. The other thing is down money. I think the conventional banking industry is looking for 25 to 30% down on real estate.
Investments.
Yes. Higher interest rate, higher down.
Higher interest rate, and the interest rate's not locked in. A lot of times, unless that's changed a little bit in these times, some maybe they have, but most of them will give you a higher interest rate, and it will be fixed for a period of time, but amortized over a longer period. So it might be a 5% interest rate fixed for 5 years, amortized over 25, but then it will reprice in the 5th year. And there'll be floors and ceilings on the interest as to how high it can go, how low it can go, and it'll reset for another 5 years. So your payments may change depending on where interest rates go. So those are some of the things that, a novice getting into buying investment property might not be aware of. A lot of real estate investors will buy a property or two, get a little equity, and then they'll use the equity in those properties for the down money on the next property. They'll have seconds on properties, second mortgages, and things of that nature.
We know a lot of people that have that have this as a business, as their full-time business, that have built wealth and do very well with it. Others, not so much. So a lot of people, it just takes a certain personality to be able to do well with this stuff. But when they go to sell these properties, there's a capital gains,
Yeah,
correct?
we'll talk about that in a second. There's one other thing to note when you take these, when you have a person that's an investor in real estate. It's the same conundrum, if you will, when someone says to you, can I deduct my mortgage interest in my tax return? Yes, you can, but maybe you won't. The other question is, can I deduct my loss on a rental activity in my tax return? The answer is yes, but it may be limited. So passive activities have limits, and they're based on your income. So rental of real property is a little unique. You're allowed to take up to a $25,000 rental loss per year. If you have a loss greater than that, which you could if you have multiple properties,
right.
Then if it's in excess of $25,000, it's going to carry over, and you're going to take it in a future year when you have more rent income. The other limit, called the passive activity loss limit, is if your income exceeds a certain level. And it's between, I think, 125 and 150. Again, that diminishes or reduces the loss that you're able to take in the current year, but it carries forward. And then you would ultimately get those losses when one of three things happen. You either have a reduction in income, so you drop below the limit. You have passive income to offset it with, or you sell the property. When you sell the property, you do pick up all the losses or net losses that you have stored in your return. So you don't lose them, but those limits aren't real high. They were high years ago when people didn't make the amount of money that they make now. But now, a lot of couples that are two working couples are making more than, 140, 150 a year. So they fall into that gap. So it's not always as big a tax break. The big thing you want to happen is to cash flow. You don't want to be putting your own cash to manage your property. You can have a loss due to depreciation in that, but you could still cash flow where you're not putting your own money in to make the mortgage payment every month. That's the key. So you really have to know what the cost of the property is going to be for you and how much your expenses are going to be, including your mortgage payment, so that you set your rents at the right amount.
Right. Good stuff there, and a great point. When things happen in Washington, when administrations change and parties change, taxes also change. And
Yes.
one of the things that I'm seeing lately is a vast amount of calls to my office regarding people that have investment income properties. They want to know. They think I know. I don't have a crystal ball, and I don't have the sense that you have because I don't do taxes and I'm not a CPA. But one of the things that I think rumored out there is that the capital gains is going to change.
There is talk of that, and you are spot on with your assessment with the tax situation. What taxpayers have to understand is Congress is who enacts tax changes. So when parties shift, depending on what the focus is of the party, it's like with the tax credits. green credits and environmental credits are big when the party is conscious
their
of
issue.
climate control.
Right.
And when they're not, those seem to disappear. A lot of those types of things in the tax code are not permanent.
Right.
They're called sunset provisions, and they run out at a certain time, and they have to be extended. And sometimes if one party enacts them, the other party won't extend them. So that's one thing that happens. As far as capital gains go, I think that if there's any changes on the horizon to capital gains, it is going to be for higher income taxpayers. But we'll talk a little bit about how gains are calculated.
Okay.
Again, on the sale of investment property. Because there's a little hidden tax consequence that a lot of investors just don't understand and they don't grasp it. The first thing to understand is you do not have a long-term capital gain unless you sell a property for more than what you paid for it. Okay, so you have to sell it for more to have a capital gain. So if you have a property that you bought for $200,000 and you have it for 10 years and you take $30,000 of depreciation over that 10 years, your tax basis in that property now is $170. And if you sell it for $250, only $50,000 of that is a capital gain. But there's also $30,000 of recaptured depreciation that you have to claim. And those two components of that capital gain or that gain are taxed at different rates.
Okay.
So the long-term capital gain is taxed at long-term capital gain rates, which could be as much as 0 and can be as much as 20%. Could be as low as 0 and high as 20 right now. But the 20% rate is only applicable if you're in that highest
tax bracket. All right.
So it's up around $500,000 of taxable income, give or take. Then the depreciation recapture portion of it
The
is
30,000.
taxed as an ordinary gain with a maximum rate of 25%, but it's not 25% if you're not in the 27% tax bracket.
And what's that? What's the income on that one?
Probably around $350 for a married couple. Because, remember, we're in a graduated tax scale, so you move through the tax brackets. But you only pay tax at that rate on the income in that bracket. So, you have a highest marginal rate and an effective rate, which are two different amounts. The effective rate is less. So that 25%, but that's really an eye-opening experience for people who are investing in real estate and are writing it off and taking a tax deduction. Because even if they're not creating a loss in their tax return, they're reducing their taxable income from the rental. And then they have to recapture that as ordinary income at the end because they deducted it out of ordinary income. There's just a tax break on that when they cap it at 25%. So that comes into play when you sell these larger commercial properties or investment properties that are multiple units or like in a big industrial building or something of that nature.
So your 2, 3, 4 unit.
Yeah, it could be if you sell it for that much. I mean, you would know more what those are going for right now than I would.
No, they're not high end. I wouldn't consider
But when you mention the current administration is talking about some tax change and possibly some in the capital gain arena.
That's what we hear at least.
But I think it's only going to affect that highest rate. So they may bump that 20% up to 25%. But again, you have to have income up there to pay that rate.
All right. I got a question for you. My neighbor's thinking about buying a condo down at the shore. He's thinking about buying one. And he said that he was going to generate, these are the numbers he gave me. He said he's going to generate $17,000 a year in income with $6,000 a year in expenses. So that gives him $11,000 of income. How is that taxed?
Yeah, correct. If that's the scenario. So that $11,000 of income comes into his tax return as rental income. It is taxed at his ordinary tax rate, which is whatever tax bracket he's in. Okay, you could have a retired couple that does that, that's only collecting Social Security, a small pension. They might only be paying 12% on that income. You have somebody else who's working and might be paying 22% on that income, maybe 24, maybe 27. There is no self-employment tax on that. Self-employment tax is Social Security tax. And a self-employed individual, someone who files their tax return on a Schedule C, they pay self-employment tax on that net income. So if that were a business, he would also be paying 15% self-employment tax on that $11,000 or $6,000 of
Right.
income.
Well, 11,000
or
income.
11,000 of income, but not in a rental activity. Now, the other thing that comes into play, there is, again, was part of a tax change a few years back, was the net investment income tax. That's another tax on top of the capital gain tax, or the tax that you would pay at the capital gain rates. And that's a 3.9% tax. But again, you have to have enough income to kick in the net investment income tax. I don't know all those calculations off the top of my head. We buy
But most people don't quote.
the higher income people do. We buy a pretty powerful tax program that does a lot of that for us. We have to be aware of it, but then we can look and see that it's all calculated correctly. But I don't know all the floors and ceilings off the top of my head on all these different
Well,
taxes.
shame on you. You
Yeah,
should.
I know.
What's
I
going
know.
on here?
I
I know.
mean, but I sit here and I think of the overused statement. There are two things sure in life, death and taxes.
Yeah.
Yes, and you can't. Well, I'm never going to die, but I'm probably going to have to pay taxes.
So capital gain taxes is not something separate that you pay when you sell something for a gain. It's just reported in your tax
Right.
return as another component of your income,
Right.
and taxed at different rates
Based.
than your ordinary earned income from your job or interest and dividend income, that kind of stuff. So it is a pretty complex system.
And that's why someone needs someone like you, Tom Cawley, CPA and partner of Cawley, Johnson and Sanders. Can I have your contact info?
Yes, my phone number is 570-563-1140, and my email address is tomc@cjspc.com.
And that's why when I get these questions, when people call and ask these questions, I say they need to speak to someone like you.
Correct. And when,
Yes.
and when my clients ask me something about legal stuff or real estate stuff, I try to direct them to the people they should talk to.
Right. We can have a general understanding, but there's nothing like going to the source. So, Pat, could you review a listing, please?
Yes, we have a lovely 3-bedroom, 2-bath home at 1145 Reynolds Avenue in Taylor for $179,000. This home sits on a 40 by 125 lot. It's in the Riverside School District. This home won't last long. It's in excellent condition. It's got beautiful hardwood flooring, tile flooring, new baths. The kitchen has been updated with Corian countertops and tile flooring. It has ductless air conditioning, a walk-up attic that could be finished, a cedar closet, and here we go, low taxes of only $1,500 a year. And it also has a beautiful in-ground pool with an enclosed back porch and a covered patio area. That's a 3-bedroom, 2-bath home with an in-ground pool at 1145 Reynolds Avenue in Taylor for $179,000, and that's listed by Jessica Ruddy of our office.
Stay with us. We'll be right back with more Real Estate Roundtable on 94.3 FM The Talker.
Who are Century 21 agents? They're high-tech gizmo-packing problem solvers with an appetite for getting things done. They know the best places to buy a home, to sell a home, and to find antiques, if you're into that kind of thing. They're weatherproof, foolproof, and proof positive that smart people doing good work can make big things happen for great folks like you. Oh, and there's one nearby. This is who they are. This is what they do. Century 21 agents. Smarter, bolder, faster. Each office is independently owned and operated.
Hi, this is Jackie Ruddy from Century 21 Jack Ruddy Real Estate. Is real estate on your mind? It's on ours 24/7. Whether you're buying, selling, investing, or in need of an appraisal, you have questions, we have answers.
Thinking of buying or selling a house and have questions? Tune in to the Real Estate Roundtable hosted by locally owned and operated Century 21 Jack Ruddy Real Estate on Saturday mornings at 11 and Sunday mornings at 11:30.
Call 570-344-6724 or visit jruddy.com. That's JRUDDY.com.
We're back with more Real Estate Roundtable with Century 21 Jack Ruddy Real Estate. We have with us Tom Cawley, CPA and partner of Cawley, Johnson and Sanders. Where do people who purchase income properties, investment properties, where do you find they make mistakes?
One of the things that happens commonly is an investor will continue to take the equity out of their property to use for whatever. A lot of people will buy real estate to down the road use the equity to put their kids through college. Then they end up selling the property. They have a big capital gain. They have tax to pay, and they have debt to pay. And then they don't walk away with much cash. So they're really disappointed after they see me.
But they took the cash.
But they took the cash
And they don't
early
see it
and
that
they
way.
used it for other things. But people are very short-sighted when they do that. So that's one pitfall to be aware of if you're going to become an investor in real estate, because you can build up equity pretty quick if you have a good rent roll. The one other thing when we talk about capital gains is like-kind exchanges. That's always a big thing. People hear about it. They don't know much about it.
And people call them 1031
They're 1031 exchange. Okay. That's the section of the tax code. And it's a pretty complex maneuver.
Yes.
However, there's a couple of things that are real quick. You must have a qualified intermediary to do the transaction for you, because you do not get the money. I am not a qualified intermediary. Oftentimes, there are companies that do that. It can't be anybody that's working with you on your deal.
Realtors aren't. Nope.
Can't be your accountant. Can't be your lawyer. But usually, real estate lawyers will have a QI that they could refer you to. A couple other things is you have to identify the property that you're going to flip it with in 45 days, and you have 180 days to close on the deal. And one other thing is...
You don't have a lot of time.
No, you have 45 days to identify the property. So if you're going to explore that, find the property before you start the process. And then you must reinvest the amount that you sell the property for that you relinquish. And if you have debt, you must carry the same amount of debt. That's the one thing that people miss in that. Oh, so you can't take all the cash and pay for it. You really can take out some equity, I guess is what you can. But if you buy a property, a replacement property, you must retain the amount of debt that you had on the first property. And that will defer the gain. It doesn't make it tax-free. It's just deferred. And then you reduce your cost basis in the one you're buying. It becomes cost basis of the one you relinquished. And depreciation resets. And then at the end of the day, when you sell that last property, you end up paying tax on the potential gain.
Okay.
Sounds pretty complicated.
It is complicated, but it's something to look at if the situation works for you. You have to want to have another property.
Right. We just had a couple people from New York do that, and it was a little tricky. Yes. But they got it done. And when they have questions like this, they can call you.
Yes.
And you can put them in contact with the proper people.
Yes.
Okay. Tom Cawley, CPA and partner of Cawley, Johnson & Sanders. How does someone get in touch with you, please?
My phone number is 570-563-1140. My email address is tomc@cjspc.com.
Okay. You want to know something?
Yes.
Okay, it's not a statistic. This is what you need to know about dog spas.
Dog spas?
I knew you were going to say that.
Dog?
At-home pet spas and showers are now a unique and sought-after selling point of newer and remodeled properties. Knowing and understanding these trends can help sellers stand out to home buyers. They want dog spas. Now, I've done a little research, and I looked at pictures on the internet, Pinterest to be exact, and they're all different types of dog spas. Some really, some are in their laundry room, tiled, and it's a shower. It's smaller than a human shower. But the ones that I would want would be mid-height, and they're stationed on the wall so that you can wash your dog.
That would be a great business for you, Patrick.
Foo-foo Pet Spa.
The Pat Devaney Pet Spa.
Nice.
But some are outdoors, some are in the basement areas, some are, very, very basic, and there's some that are high-end, tiled and everything.
You know what I saw in my travels over the summer? A dog ice cream place. They were selling ice cream for your pet, and there was people going in there with the little foo-foo dogs under their arms and big dogs, and they were getting plates of ice cream for Fido or Spot or whoever. I was like,
It's a thing. It's a thing.
We love our dogs.
We love our dogs and our pets, right?
It's not around here.
We're out of time. Thanks for tuning into the Real Estate Roundtable with Century 21 Jack Ruddy Real Estate. Remember, we're here next Saturday at 11 a.m. and Sunday at 11:30 a.m. on 94.3 FM The Talker.